In this case, the top side is absolutely flat, and you've got a rising bottom to the pennant. And that is actually quite bullish when it breaks out. It rather indicates that the consolidation has been knocking to try and get out, and eventually it will get out. And of course, the moving averages have all caught up with it and so on. So, but the underlying momentum, bull market momentum is still there. And bearing in mind that what we're looking at is risk in currencies. People are trying to get out of currencies. That is why bond yields are going up. They're all in debt traps. And that really means that eventually gold will break out on the upside. And I guess it will coincide with quite a sharp move upwards in long bond yields. And I don't think that time is very, very far away. I think it could be a matter of weeks, literally, rather than months.
Markets often disguise deep fragility beneath calm charts, but when you peel back the layers, the story is stark. Currencies, debt, and central banks are all stretched to their limits. What we're seeing now in gold is not just a technical setup, but a reflection of systemic cracks in the global financial system. A flat-topped pennant with rising support suggests bullish momentum is building, and when this structure breaks, it could mark the beginning of something dramatic. Rising bond yields across major economies highlight what investors already sense. People are desperate to move out of paper promises and into tangible assets. Alasdair Macleod, a veteran market strategist, has spent decades observing cycles of speculation, collapse, and recovery. His perspective brings clarity to this moment of confusion. He reminds us that central banks have been kicking the can down the road since the 1960s, trying to manage unsustainable debt with artificial tools. From the end of Bretton Woods to today's $3,400 gold price, the dollar has lost more than 99% of its purchasing power. Sterling has fared even worse. What makes this moment so precarious is its universality. Debt to GDP ratios across the G7 are well above 100%, and governments have become trapped in a cycle where new borrowing no longer produces real growth. Instead, it simply inflates financial markets, fuels speculation, and leaves banks hesitant to lend into the real economy. The result is distorted credit flows, record leverage, and mounting systemic risk. As central banks lose control over long-term rates and rely increasingly on short-term funding, the inevitability of a break becomes clear. History suggests that when currencies fail, gold tends to assert itself. If you value these insights, make sure to like, subscribe, and turn on notifications so you don't miss the next update.
I think one of the problems in this is that if it was just one nation in trouble, then I think the others could rally round. You get, let's say it was a problem for the Bank of England, which it is actually, but nobody else had quite that problem. You would have swap lines being, sort of quietly put in place and all the rest of it, because other central bankers will be aware of the problems. But this one is everywhere. It's not just something starting somewhere, and maybe, if it's mishandled, it's going to have knock-on effects elsewhere. It's not like that. It is everywhere. And at the end of the day, there's the old market phrase. You would say the markets always win out at the end. And we've been kicking the can down the road, really, since the 1960s. And the first sort of blip in that was the end of Bretton Woods. It started off with gold pool failing and all this sort of stuff. They're trying to sort of keep the thing up, as it were. And they've kicked the can down the road, They've devalued the dollar, measured against real money, from $35 an ounce in 1971 to around about $3,400 today. It's lost 99% of its value virtually. That's what's happened to the dollar, and it's even worse if you look at sterling. We have a coin which is the sovereign, and the sovereign was once the most common gold coin in the world. And when you look at a Bank of England note, it says from the chief cashier, I promise to pay the bearer, if it's a £10 note, £10, on demand. Now that £10 is 10 sovereign coins. A sovereign coin today is £600. So you can see what's happened to sterling over the years. Basically, these currencies have gone down and down and down. And what we're looking at now is an acceleration into oblivion. And it's taking all forms of credit with it. Everybody thinks wrongly that the Fed can always control interest rates and introduce yield curve control and things like that. That is not the case. In normal times, when things are not too challenging, yes, they can do that. But we now have a situation where debt to GDP in the US is well over 100%, 125% or whatever, depending on what your view of GDP is. We've got high GDPs all the way around the world in all the G7 countries now. We're looking at an average of 100 or maybe slightly more. I mean, France is about 110, I think. UK is about 100. Germany is a bit lower, but they've just raised their debt limits because they're going to spend money buying military equipment off the Americans to expend in the Ukraine. They're all very highly indebted, and these are debt traps. I mean, by definition, when you find that economies are stagnating and debt is still growing, it's debt which is not being deployed productively by any stretch of the imagination. You're looking at something which is actually just eventually going to collapse. Central banks can delay things. They have delayed things. But I think this one is getting out of their control. I really do. I mean, the Fed has already effectively admitted that it can't fund out along the yield curve. It's tried to and found that auctions have been disappointing, to use the recurring phrase. The only funding they can really do for the US Treasury really is short term. I mean, it's less than 5 years, certainly less than 2 years. And, really it's a reliance on T-bills. And this is why there was this debate within the Fed, including input on compliance vis-a-vis Basel III, as to whether they could get rid of the supplementary leverage ratio or reduce it anyway, which would give the banks room to buy more T-bills. I mean, the banks are willing to do it because all the regulators tell them that the risk-free investment is a T-bill, and the banks don't want risk. They see things out there which I don't think they would really want to admit to. Occasionally, you get Jamie Dimon standing up and saying something which is rather controversial. But, I reckon that, the bank's internal research on, the state of the US economy, I think shows that, things are just not good. So they don't want to lend money all around the country. And I think this is partly why they seem to be quite happy to puff up financial markets by directing bank credit in that direction. And, the result is you've got over $1 trillion, according to FINRA, being lent to, margin players in the equity market. This is very, very much end of era stuff. It really is.
In today's financial landscape, the focus has shifted from chasing growth to preserving what remains. The era of endlessly accumulating wealth through inflated assets is drawing to a close. Equity valuations are stretched beyond reason, bond yields are climbing, and the very foundation of global credit systems is weakening. History shows us that in times of currency collapse, traditional assets like property can lose nearly all value when priced in sound money. Germany's 1920s hyperinflation is a striking example. Entire estates and houses once worth fortunes were reduced to the equivalent of a few ounces of gold. Those who held real money, gold, were able to purchase tangible assets for pennies on the dollar, while the middle class was devastated. This is the key lesson for today. The real danger is not rising prices, but collapsing currencies. Inflation is merely the symptom of monetary decay. Credit-based money, backed only by promises, is unraveling. In contrast, corporeal money, gold and silver, retains value because it carries no counterparty risk. Understanding this distinction is critical. As debt traps tighten and central banks lose control, wealth protection means moving away from paper illusions and toward tangible, enduring stores of value. Let's get back to the interview.
The way you've got to look at your wealth nowadays is not to accumulate any more wealth. Those days are done. What you've got to do is you've got to focus on protecting what you've got. And you have to think very, very hard about what the values of the things you have are going to be in the future. Equities, as I've said, that is already the valuation is so incredibly stretched with bonds. And now we're talking about bond yields rising even further. The equity market is going to crash. Firm prediction. People think property. Well, I don't know about in over on the other side of the pond, but over here in the UK, property values depend on financing through mortgages. But also, if you look back to previous currency collapses, and I think I want to use that phrase rather than hyperinflation, currency collapses. I think that one of the best documented was Germany in 1922 to 1923. You could buy a house in Berlin, 6 bedrooms, decent part of the city. 1923, you could pick that up for $100. And that house, $100 was slightly less than 5 ounces of gold because the exchange rate at the time was 20.67. That is the difference between the purchasing power of gold and a collapsing currency. I don't know how many billions or trillions of Deutschmarks you would have to pay to buy a house like that. But in gold, its value just completely collapsed. And this is why the inflation kings, Hugo Stinnes at the time, was able to buy, he had something like fully 25% of the German economy under his belt. He was buying country estates and all the rest of it for nothing, absolutely nothing. Why? Because all the sort of the bourgeoisie, the people are socialists in this country are trying to kick downstairs. They were all impoverished. They were literally starving. So you've got to think very hard about how you protect yourself in a currency collapse, because that is actually what the bond markets are now telling us. And you have to understand the difference between credit and real money. You've got what's called corporeal money, which is physical money, which you possess, which has no counterparty risk, and that is metallic. It is gold and possibly silver. And you've got incorporeal money, which is credit. It doesn't exist. It's got no presence. That is the bit that is collapsing because it's no longer tied. The whole point about a currency with a gold standard is that the currency becomes a gold substitute. It gets tied to the value of gold. So you can increase the money supply particularly if you use it to increase production, to finance the increase in production, as opposed to finance the increase in consumption. But basically, that's what it is. When you get the discipline of gold in there, then you find you don't get prices rising. Why are prices rising? Because the currencies are going down. This whole idea that inflation is rising prices is an absolute load of rubbish. It's currency collapsing. And I think, to get on to your question, the only final words, I think people have got to try and understand this. And that's my mission, basically, to try and get people to understand it.
The evidence is becoming harder to ignore. Across markets, currencies, and political systems, the pattern is consistent. We are approaching the end of an era defined by debt expansion and fiat illusions. Rising bond yields, overstretched equity markets, and relentless currency debasement are not isolated events. They are symptoms of a structural collapse in confidence. As was the case in Germany during the early 1920s, when fortunes evaporated overnight and wealth was transferred to those holding sound money, today's environment points to a similar reordering. Property, equities, and bonds may appear stable in nominal terms, but when priced in real terms, such as gold, they reveal decades of decline. What we are witnessing now is not simply inflation, it is the slow unraveling of paper promises, of credit money detached from anything tangible. Gold and silver, incorruptible and free from counterparty risk, remain the ultimate barometers of truth in this distorted system. For those willing to see the signs, the message is clear. This is not a time to chase returns, but a time to protect what remains and position for the reset that history tells us always follows. The urgency is real because this crisis has a global scope. Every primary currency, every G7 economy, is deep in the same debt trap. The solutions being attempted, more printing, more manipulation, only accelerate the inevitable. Eventually, markets win, and when they do, the shift will be violent, rapid, and unforgiving. If you found this analysis insightful, make sure to like this video, subscribe to our channel, and turn on notifications so you don't miss our next update. Your engagement helps us continue bringing independent, fact-driven perspectives on the changes shaping our financial future.